Imagine you're at a farmer's market, and the price of your favorite vegetable fluctuates wildly every week. Instead of buying all your veggies in one go when they're cheap, what if you bought just a little bit each visit? That's dollar cost averaging, and it might be the secret to beating most investors without breaking a sweat. Dollar cost averaging is simple. Invest a fixed amount regularly over time, no matter the market price. It's like filling up your piggy bank with coins every payday instead of trying to guess when the best day is. Let's debunk a myth. Dollar cost averaging isn't about timing the market. It's about removing emotion from investing. By buying at regular intervals, you avoid both buyers' and sellers' remorse. Take Alice, who invests $100 every month for 5 years into an index fund with fluctuating returns. At the end of her period, she has more than if she had dumped all her money at once on day one. So why does this matter to you? Let's say you start with $100 a month into an S&P 500 index fund. Over 5 years, assuming an average annual return of 7%, your $6,000 would grow to nearly $8,000. Remember, dollar cost averaging won't guarantee you'll make money, but it can smooth out the volatility and reduce risk. It's like buying vegetables at a steady price instead of guessing peak freshness days every week. Before we wrap up, keep in mind that while dollar cost averaging is a great strategy, it's not personalized financial advice. Always do your research and consult with a professional when making important investment decisions. So there you have it. The power of patience in investing can be more rewarding than high-risk moves. If you found this useful, give us a thumbs up and don't forget to subscribe for more smart, no-nonsense money tips.